Today on Your Money, Your Wealth, Joe and Big Al spit all over your retirement plans. No, sorry, this says they spitball ideas for your retirement plans. First, they'll look at several aspects of retirement for a couple who wants to retire early. Should they be investing in brokerage and Roth accounts instead of pre-tax accounts? How should they optimize their tax diversification? Should they take the pension lump sum or the annuity? And what about paying for kids' college education? Then, how do you figure out what your retirement number is so that you can set your savings on autopilot? They'll spitball ideas about that too. Next, what exactly is this life insurance investment you hear about on the radio with a guaranteed 10% return? Do dividend-paying stocks have a higher rate of return than the ever-popular VTSAX? And should you hold individual stocks in a taxable account? And when should you jump into the market given how COVID crazy things are right now? I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, the shot callers, the spitballers themselves, Joe Anderson, CFP, and Big Al Clopine, CPA.
Brandon from Minnetonka.
Oh, sweet.
All right.
That's going to be near you somewhere.
Yes, sir. Hey there, Andy. So bear with me, folks, because
it's a book.
It's a book. There's this is one of the longest emails in the history, and I'm going to try to go through it fairly quickly. I'm not
just kind of paraphrase if you can.
If I can, kind of skip around a little bit, but I don't want to miss anything because I think it's important and on. So, okay. But trust me, I listen to myself sometimes when I'm reading this, and it's like, this is painful just to even listen to. All right. Hey there, Andy, Al, and Joe. Best podcast ever. Seriously. It isn't even close. The blend of you three is fantastic. Thank you. Money is supposed to be fun, and you folks do an outstanding job of making it so. I find myself laughing, nodding in agreement, and shaking my head from time to time in a good way because of one of the crew's responses. You guys and gal are awesome. We live in Minnetonka, the Twin Cities of Minnesota. Shout out to you, Joe. All right, brother. And have a family cabin cottage on Lake Pepin, right on the Mississippi River in Wisconsin. We've been married 22 plus years, have 2 kids. The COVID-19 happening have fast forward our early retirement plans, and I am, for the most part, retired at age 47. Look at Brandon. Look at the big, bad wallet on Brandon.
Wow, that was my goal, wasn't it?
It was.
47.
47.
Here I am still working.
Hey, stop with the chit-chat, Al.
I know, sorry.
COVID-19 doesn't bode well for keynote speaker, author, trainer guy.
Probably not.
Yeah, I wonder what kind of
keynote speaker.
Yeah.
Ooh, we're looking for people at our webinars. Maybe you could help us.
Yeah, maybe a guest.
Yeah.
My wife, IT industry, will retire in the next 9 months or 2 years, for sure by July 1st, 2020. I would love your insight on a few questions, so here is the info.
Okay.
All right.
This is where you're going to start paraphrasing?
I'm going to try because this is where it gets a little... Okay, income. Wife salary annually, which easily covers all of our annual expenses, is $110,000. Wife maxes out 401k each year, and health insurance also is covered. Commercial real estate is also $20,000 and will continue in retirement. So right now they got about $130,000 of income. $20,000 of that is real estate income that will continue.
Got it.
Okay, wife will receive a pension of $300 to $350 with her retirement and has a current option based off the following potential retirement dates. There's a 50% survivor annuity attached to the pension. It looks like March 1st and July 1st are the dates the pension increases each year. Deferring payment grows the amount total of about $12,000 to $15,000 a year. So he can either take a lump sum or an annuity payment, roughly $300,000 or roughly $900 a month.
Yeah, okay.
All right. They got zero debt, one of our best decisions. We love the freedom, independence. Good for you. No debt.
Yeah. Like it.
Current spending, $50,000 a year. They don't really spend a lot of money. I suppose living in Minnetonka, there's...
Even with 2 homes, huh?
Yeah.
But they got to pay it off, so that's why.
Well, property taxes alone here would be $50,000.
Yeah, that's right.
When wife fully retires, we plan on traveling. So we would increase our spending to $70,000. However, we have $20,000 income from the commercial real estate. So we'd like our portfolio to provide the additional $50,000 a year for spending in creating memories. We will also be paying $80,000 to $100,000 each for our kids' college using 529 plan scholarships and pulling from retirement accounts that allows for educational purposes. All right. So did he tell us how many kids he's got?
Not that I saw.
All right.
He does. He's got two, a 16-year-old and a 13-year-old.
2 kids.
All
I
right.
see it now.
Got it. Okay, current portfolio, post-tax. So he's got $360,000 in savings. 401k plans is about $1 million. Traditional IRAs, $300,000. Roth IRAs, $200,000. $75,000 in 529 plans. So there we have it. We got a 16-year-old and a 13-year-old.
Yep. Okay.
Cool. All right. So what do they got? 1 point, call it $4 million in retirement accounts.
Yep.
That is pre-tax, $200,000 in Roth accounts, and another, call it rounding, $400,000 in after-tax savings and brokerage.
Okay. All
right.
That makes sense.
Okay. So here's some questions. Should we stop any pre-tax retirement account savings and invest that money into a brokerage account? This will be the first year we qualify for Roth IRAs because our AGI was too high over the past several years. Since we are heavy in the pre-tax retirement accounts, what do you think? Let's see. Yeah, they got $110,000 of income. They file married. So taxable income, I'm guessing, is she fully funds the 401k plan. They're in the 12% tax bracket. Yes, for sure. Jam up on Roth contributions. You'd probably even look at conversions. But any additional savings, I would go in Roth or after tax, just because of the tax bracket. I'm guessing that commercial real estate, $20,000 annually, maybe there's some shelter through depreciation there.
Yeah, you would assume that a lot of that would be sheltered with depreciation. So their tax bracket's not that high, right? Correct. Based upon what we have here.
Yep.
So let's get the money in, more money in the Roth.
Absolutely. What would your suggestion for asset location to help provide our desired income and minimize taxes? Our plan is to focus heavily on Roth conversions ladder strategy over the coming years as our income continues to go down. Can you speak to that plan in regards to how much to do each year and the reasons why this may not be the best strategy in our situation? So asset location, I guess, I think you're confused on some terms here. There's asset diversification, and then there's asset location. Asset location means how do you invest the Roth accounts, the non-qualified accounts in your retirement accounts. Tax diversification is more how much money should I have in the Roth accounts versus pre-tax versus after tax.
Sure.
So if I'm looking at a 47-year-old that has $1.4 million in retirement accounts that only spends $50,000 a year, I think the strategy is to convert at least to the top of the 12 and then look at the top of the 22 until the tax law changes.
Yeah, that makes sense. And so the top, they'll be in the 22% currently while his wife's working. But still, the 22% is a pretty low bracket. And certainly, if she retires in a couple of years, then you may potentially be in a low bracket for quite some time. So you can convert in the 12% bracket, which later will become the 15% bracket. Still a really nice low bracket. You can probably get a lot converted. But I wouldn't necessarily forego the 22% bracket because that's still a pretty low rate. So that's where maybe a little planning comes in. You kind of do some math to figure out what's the best tax rate. But yeah, I think if it were me, I would be tempted to go up to the top of the 22.
Right. If I was Brandon, I'd be just taking a simple spreadsheet.
Yeah.
And then I would have different columns for my different assets and say, well, 50,000, and given an inflation factor, that's the need for the overall portfolio.
Yeah.
And so if he's got $350,000, let's say or $360 in non-qualified accounts.
Yeah.
So, you're looking at, that's about 7 years of providing $50,000 of income with no growth on that money.
Right.
So, but he also needs to pay the tax on the conversions. So he's 47. He can touch the money not until. Does he get did he say 457 plan too? I think he does. So he could draw on that at any time.
He says solo 401k, and his wife has a 401k. He's got a traditional IRA. Wife's got a 401 IRA.
Oh, I thought I said 457 plan.
So, but the challenge, as I see it, is there's only so much money to pay the tax on the conversions, to pay for your living costs, and to pay for your kids' college. So it's a balancing act, right?
Right. So you're going to have to look at the total net worth of everything. In some of the case, you know what this case is, and he's not going to like what I'm about to talk about, but debt would be a fairly good option for this individual. Take out a home equity line or something like that just to create a little bit more liquidity, even though he's very proud to be zero debt free. But you have to look at, all right, well, let's say if I get a home equity line with interest rates at 3%, that I can utilize some capital versus taking larger distributions from a 401k plan to pay for additional expenses and paying a tax at 25% or 28%. I mean, would you rather pay a little bit of interest or pay that much more to the IRS, especially with the commercial property? Maybe you could lever that up and have the rents pay that note to create some liquidity there. So, I mean, there's a lot of moving parts and options, and we're just kind of spitballing here.
Yeah, and I think, you don't take on debt lightly.
Absolutely not.
But nevertheless, it in this particular circumstance, because there's a lot of net worth and low spending, right? That maybe it does make some sense, because later a lot later, but later there will be Social Security, right? And there'll be, we got the pension, we haven't talked about that. Probably you want to take the lump sum. When you look at how low the monthly payments are, they're not very high.
But let's say 20 years from now, there's still, the living expenses are relatively low, and their income is going to be pushing them up into a very high tax bracket, do the required distributions.
Agreed.
And then with the Social Security.
Yeah, because if you add, say, a $300,000 lump sum to their pre-tax, now it's about $1.6 million. By the time they have to take RMDs, it's probably $5 million or above, right?
Because it's like his third question here, and then we'll have to get to a break here, is that what is your suggestion when it comes to use the distribution of the pension plan? Go with the lump sum, pay the taxes, and use the remainder to help with the taxes on the Roth conversions? See, well, good news for you, Brandon, here. When you take the lump sum, it's not going to be fully taxable in the year that you take it. You roll it into an IRA and take those distributions out accordingly.
Yeah, when you need it.
When you need it. So again, when you're looking at your total net worth of things, he's already picturing, all right, if I take $350,000 out as a lump sum, I'm going to pay $100,000, $150,000 of tax. I'm left with $150,000 to help pay the tax. Again, you might want to think about using the equity potentially, because you have so much net worth, but most of it is still qualified, and you're young enough and you'll have the income that you can create the liquidity that you need to do some planning. But again, you could do this without that as well.
Yeah, and if he takes if he does that, which probably should take the lump sum, but then he can't really take the money out of that without paying penalty, right?
Right.
So you got that problem. You could do a 72T election, maybe, if you need some more income. So, I mean, there's a lot of possibilities here.
Yeah, the 72T tax election would allow you to avoid the 10% penalty, but then it jams him up because he has to take a separate equal periodic payment now until he turns
59
60.
Yeah, right.
And so that's additional income that maybe he needs or not.
Agreed.
Yep.
I think he might need it, though, because especially if he uses his brokerage money for Roth conversion taxes in college. So I don't know. There's a lot of math here to be done.
Yeah.
So you're right. I mean, we just spitballed. Here's a few ideas to at least think about it.
I think Brandon did an awesome job.
Yeah,
right?
For sure.
Great saver, low spender.
Yep, for sure.
Spend a little bit more. Enjoy it. Right. I mean, you're a keynote speaker. I wonder what he talked about.
Yeah, probably talked about saving money.
Yeah, how
to save,
how to kick ass and save a ton of money.
Yeah.
And retire at 47 with more assets than most. So congratulations, Brandon. See, it's the good folks from Minnesota.
They're always smart, aren't they?
You know what? They're hell of people.
I should say they're usually smart.
Yeah. We got ML in the Northeast. It's pretty broad.
Yeah, that is pretty broad.
Northeast is pretty big.
We have a general region. I'm imagining Vermont.
Could be. That's a good vision.
Yeah.
So here we go. Hello. I love the show and curious if you can help me come up with a retirement number to aim for. I'm sure we can help you with that, ML. I want to set aside the necessary amount each month and put it all on autopilot, but I don't know how much I will spend as I approach retirement, nor do I know what our salary will be so far down the road. We are 41 and have 4 kids, so I feel that a lot is going on, and it's going to happen from now until then. When it comes to college savings, Vanguard has a wonderful page that allows you to input which school you'd like to save for, what your current currently having 529 plans, expected returns, etc. Vanguard then figures out how much school will cost when your child turns 18 and tells you exactly how much money that you need to save. So they're making low household income, Al, $475,000 to $500,000. Very healthy income, ML, from the Northeast.
Right.
My wife will go back to work in about 5 years as a teacher. We will put $3,200 a month into a 529 plans, $800 kit per month. Currently, they have $110,000. I max out my 401k plan. My company match and profit sharing gets me to the IRS max of $56K into the 401k. Currently have about $500,000 in 401k plans. I do the maximum backdoor Roth for my wife and I each year. Currently about $200,000 in Roths. I max out my HSA every year. I invest $6,000 a month into a taxable account at Vanguard. What's the total amount in that? So you invest $72,000 a year there. I've been saving at this rate for about a year as I recently got a raise. I hope to continue until retirement, but who knows what the future brings. Thought on a number I should aim for. Feel free to send any thoughts on my financial information as well. Thanks in advance for your input. Okay, so here's and I guess he gets this too, and it's a problem.
Right. You're in your early 40s, and I don't know what I'm going to spend at 65.
Exactly.
Or 60 or whenever I'm going to retire.
Who the hell knows? And it's like, I understand retirement planning, but I like what he's doing. He's just throwing a ton of money at some accounts.
Right.
But let's just look at it like this. I'm going to do some math for you. As I'm going to skip the 529 plans because he already went to the Vanguard, and the Vanguard
did that analysis.
And the Vanguard helped him.
Okay.
So he's got $500,000. He's saving $56,000 a year there, plus 72.
Yep.
So that's, I'm going to say he's saving
that's about 130
plus. Yeah, I'm going to go 140.
140. Okay.
And then he's 42 years old.
Mm-hmm.
And 42. So he wants to retire when?
He's 41, but I'm not sure.
41. Did he say when he wants?
Yes, 41, 4 kids.
I know. Is retirement date? Call it, I don't know, 20 years?
Yeah, let's call it 20 years. I like that.
20 years, 7%. Future value is $8 million.
Yeah.
All right. So 4% of that is $323,000 a year. He's making right now $500,000. Take away taxes of about $200,000 plus his savings of $250,000 plus healthcare plus this plus that. He's probably spending spending with 4 kids is probably $200,000.
Yeah, maybe not that high, but
not even that because he's saving $120,000 on top of that. So call it $150,000.
Right.
With 4 kids, that's reasonable.
That's pretty good.
If he keeps doing what he's doing at 20 years, he's going to have the same living expenses, or he's going to have the same purchasing power or higher.
Yeah, that's what I think too. I think I don't like rules of thumb, but I'm going to say one anyway. And that is, if you can get to saving at least 20% of your income, you should be fine over the long term. And he's saving more than 20% of his income.
Right. Exactly. So what we had to shoot for a number, I guess, 20%, or maybe just shoot for because he's in a fairly high tax bracket, trying to go because 20% is gross.
Yeah. Maybe
you try to go with 30% net.
Yeah, you could do that. But I think that's a real simple calculation is 20% of 500,000. That's 100K. And he's already saving more than that. So, I mean, you can do a full financial plan, and I can tell you this will probably look pretty good. But
but there's so many unknowns.
I know there's a lot, right? And that's his problem. He wants a number, and it's almost impossible to say. It depends upon your assumptions, right?
Exactly.
All I'm saying is, if you save at least 20% of your income, in almost all scenarios, you'll be fine.
I would agree with that. I think what with him is keep saving as much as you possibly can.
Yeah, and it's okay to save more than 20%.
Exactly. If you could save 50% of your net over the next 3-4 years, then you can be on cruise control.
You know, that fire generation, they'll save 85%, right?
Yeah.
Right. Financial independence, retire early, and people are retiring in their 30s. Of course, they're spending nothing, but that's a choice, right?
Right. Well, yeah, we just had Brandon from Wisconsin. So he's 47.
Right.
And he's got about $3 million.
Right.
So he's on his way there at 41.
Right.
You know, and he retired at 47, but they're only spending $50,000. He's got 4 kids that are still pretty young.
Yeah.
I couldn't imagine. I don't have any kids. I have myself. And
that's enough kid for you.
It's hard enough to stay afloat.
The DIY Retirement Guide is our special offer at yourmoneyyourwealth.com right now, but it's only available for the next few days. This free 48-page guide has steps to understand and plan your retirement income, strategies for choosing a tax-efficient distribution method, tips on preparing for the unexpected, and much more. Click the link in the description of today's episode in your podcast app to go to the show notes and download the DIY Retirement Guide, but do it soon. It's only going to be there for the next couple of days. While you're there, check out the all-new episode of the Your Money, Your Wealth TV show on investing in volatile markets. Timely, isn't it? Got questions? Click Ask Joe and Al on air in the podcast show notes and send the fellas an email.
You know, we've been holding on to this one for a while. I don't know why. But...
Well, let's get to it then.
Okay, we got Bruce, our buddy Bruce from Jersey, writes in. Well, I think he wrote this to Andy.
It looks like it.
Andy Last, the Wonder Woman of YMYW. Hello, number 1, Joe. Number 2, Big Al. Number 3, Andy. Hope Joe is happy with first billing. I am very much, Bruce. Thank you. I've been hearing on the radio about an investment that's not universal life insurance, and it guarantees 10% return. Now, guarantee is in quotes. It must be legal if it keeps popping up on the popular news radio station, right? Let's see. From what I found out, in my limited understanding, I think it's buying somebody's whole life insurance for higher than the surrender amount, but lower than the cash value, hence guaranteed earnings. I've never heard this on your show. Can you check it out? Yeah, all right. Bruce, what? You're going to hear a lot of crap on the radio, especially this show. And what? Just kind of be careful when you're when you're hearing guarantees. Al and I used to be on a station in San Diego, and there was a gentleman that followed us. Wasn't he on right after us?
He was right on after us, correct.
And he would talk about all sorts of alternatives. And this is back in 2008.
Right. Because the market was tanking, and he was actually a really good speaker.
And so Al and I would be, talking the same BS. I mean, it's almost the identical show, probably the same content.
Probably.
And so he would then come on after us, and this is when we would do it live in the studio, and he would be in the lobby looking, and then come in. Right. Now we have our studio in our own office. We don't have to go to the radio station. But then it's like, well, yeah, if you're listening to guys that talk about standard investments such as stocks, bonds, real estate, you need to get rid of those people because, I have an investment that can guarantee X, and these are alternatives, and this is what, the multi-rich and, billionaires invest in and everything else.
Yeah, and you should be able to get some of this too.
Right, and I'm going to make it available to all of you.
Right.
If you call this number, right, or something like that.
Yeah.
Bruce, guess where he's sitting today? He's in
jail.
He's in jail.
Yes.
San Diego, somewhere. I don't know if he's in San Diego or Southern California. I don't know where the hell he is. The guy was a punk, and our office used to be next to his. He tried to do a lot of things to mimic our firm, but offered just really crappy products that were filled with conflicts of interest. And I don't know if they were like Ponzi type, but how he marketed them, and then like the fees and commissions that were never disclosed and the conflicts of interest that were never disclosed, they basically barred the guy from the industry. But he did get a lot of business.
He did. I remember you and I for quite a while wondered how he could get away with this. Well, In fact, he didn't get away with it.
Yeah, right. It's like, we're like, what the hell how can he say this crap?
Yeah, you're not allowed to say that stuff.
Right. And then lo and behold, just be careful. If someone's touting a 10% rate of return or any type of return on investment, the risk-free rate right now is like 1%.
It's exactly 1.
Right. Yeah. And so it's going to probably go lower given where interest rates are. Right. So we call the risk-free rate, the treasury.
Yeah, that's right.
And even they have risks. The treasury could go, negative, I suppose. Right. Yeah. So be careful. The 10% rate of return especially in today's environment, it is almost impossible, if not impossible. It is impossible to guarantee that. But to have a consistent 10% return it's a 0.001% chance that could ever happen.
Right.
Right. But I think for an average investor or an individual investor that is not necessarily sophisticated, they hear 10% and they're like, you know what? I want some of that.
Yeah, because I just went to my bank and they offered me 1%.
Right.
So 10 looks pretty good.
Or they could have experience with investing in a diversified portfolio that maybe produced a 10% rate of return or a 12% rate of return.
Yeah, for a while.
And then they're like, hey, this is safer and I could get a 10% rate of return. Why wouldn't I do that?
Right.
Basically, what this guy is selling, and it's like a better financial plan or something like that. I don't really want to tout this dude or even give him props. But they're viaticals. A lot of it is what is called a viatical or life settlements. Al, remember the life settlements?
I do, right.
And so what a life settlement or a viatical is that, let's say I have life insurance on my life. And Alan says, you know what? I will pay those premiums for you.
Yeah, because I think you're going to kick the bucket sooner than you do.
Right.
And sooner than the insurance company thinks.
Yes. And I can't pay my premiums anymore, or I don't want the insurance anymore.
And I think there's an investment here because I think you're going down.
Right.
So I go, Joe, I'll buy it from you.
I'll buy it from you.
Here's $100,000. Right. Whatever.
Let's say my death benefit is $1 million.
I'll pay $100,000 for it and I'll start making the payments.
Yep.
Because I think this is a pretty good investment for me.
So then Al takes over my life insurance. So he's got an insured interest on my life.
Right. Which usually isn't a good thing.
I know. It's never a good thing if it's not your spouse.
Or even if it is your spouse.
Yeah, right. Exactly. And so I die, and then Al gets the $1 million. So he's like, here. And so what they do is they package these up. So it's not usually on one life because Al might find a hitman to kill me.
Isn't it like usually a double-blind trust?
Yes.
So you don't know who it is.
You don't know who the hell it is and everything else. And so they got certain life expectancies. They pay into these premiums. And so they used to call them death bonds because you pay a premium and then it's a bond. The bond is going to mature when that person dies.
Right.
And so what he's doing is buying viaticals and selling them. Or you could buy viatical on the open exchange if you wanted to. So just you can Google viatical or life settlement. So that is exactly what's going on in that guy's world. So if you want that as a diversifier, by all means, but just understand what you're buying. Of course, he's not saying that, hey, we want people to die because then we're taking advantage of the death benefit. He's saying, hey, I got an alternative that's going to pay you 10%. Just be careful out there. Bruce has got another couple of questions here for us, Big Al.
All right, let's see.
He just realized that some stocks have, for an example, a 5% dividend, while Vanguard fund, VTSAX, only has 1.77. Since Vanguard can double in 10 years, does that mean the stock can sextuple in 10 years? Or are they calculated differently? I don't know where Bruce from Jersey's going from here.
Well, I think he's asking, does a high dividend paying stock, has that a higher rate of return?
You got to look at total return, Bruce.
Yeah, that's what he's missing, right?
So you're either going to have capital appreciation of the stock. So let's say the stock is trading at $10 a share and it goes to $12 a share. It doesn't produce a dividend. You could have another stock that stays at $10 a share, but produces a $2 dividend.
Yeah, same. Right?
Same. You got the same total return.
So I think what people don't understand, if there's a company that's paying a 5% dividend every year, their value is going down 5%. Now, it may go up because of other factors, but if you just look at that one transaction in a vacuum. The day you declare that dividend, you get the dividend, yes, $100 stock, $5 dividend, right? But now your stock is worth $95. So you just have part of it in cash.
Yeah, and you know how many arguments we've gotten with other people?
I know.
You are out of your mind. That is not how it works.
Because it went up the next day. Well, it might have because of market forces.
Volatility.
Right. But if there was no market volatility, that's the exact mathematics is how this works.
Exactly. So you just got to take a look at, what is the goal? You know, what are you trying to accomplish? So it's not like you get the dividend and the stock price stays and then it doubles. So I see what you're trying to get after there, but just understand that the stock price goes down the same amount as the dividend that is distributed. And then he's got another question here. I had funds during the market crash, middle of March, and thought about it, then started to invest. Okay. So this is a request, I guess.
Yeah.
Believing the market will get worse due to the continued shutdown, I waited for a better price. April, May, June. Market is still crazy. Still in shutdown. Many people are still employed. Riots happening. And, the coronavirus hasn't been cured. Vanguard funds are almost back to how much they were, meaning I missed the discount. I'm requesting your permission on what to do. Invest a little more anyway, and maybe it can still go down. In the past, of course, no guarantee, but the downturn didn't reoccur until months later. What can you make of this economy? Thanks and stay healthy. All right. So, Bruce, couple things. When I like how he talks about Vanguard as like a particular investment.
Right. Yeah. It's just, the Vanguard one. They got hundreds of them.
Vanguard is a fund company, mutual fund company that is a very good company. Al and I both like Vanguard and recommend Vanguard to our clients. And I personally invest in Vanguard funds.
I do too.
So, but it's a fun company. So when you say Vanguard totally recovered, and let's say he's got Schwab didn't. Well, it depends on what's invested in the Vanguard fund versus, let's say, the Schwab fund.
Right.
So just understand that Vanguard is the grocery store. You can still buy anything you want inside the grocery store. It's Vanguard, Schwab, TD Ameritrade, whatever. They have their proprietary funds, and there's hundreds of these proprietary funds. So just when you say Vanguard, be more specific to, all right, large cap, small cap, mid cap, whatever.
Right.
Like you did here with your VTSAX fund.
Yeah. So I'm assuming when he's saying the Vanguard funds are almost back to how much they were, he's talking about an equity fund, maybe a U.S. equity fund.
Yeah, because
probably large S&P, let's just say.
Markets tanked, markets came back.
And I was waiting for a good price, right? And because things are getting way worse, and then it ticked up a little bit in April. I thought, well, it's going to go back. I'm going to wait. And May it went up again. June it went up again.
No,
here we are, July up again.
It's like,
how do you make sense of that?
It's a challenging predicament, because if you went into cash, right?
Yeah.
Let's say you went into cash in March. What the hell do you do? Yeah. How hard would it be to get back in the market today?
It'd be totally hard. I mean, because you probably got into cash after the market tanked because you got worried.
Right, because you saw a decline in your balance.
Right. And so then it's like, okay, I'm gonna wait because till it hits bottom, then I'm gonna buy back, and then all of a sudden, it's more than when I sold it.
Right.
Right. And how do I get back in? This whole market timing thing is very tricky. That's why we don't recommend it, because it's almost impossible. Because you can say all these bad things are happening, and Bruce, you're right. But will the market respond in kind or accordingly? Not necessarily.
Yeah, because the market responds to, is it good or as bad as expected?
Yeah, and it's forward looking, so there's an anticipation we're going to get better, right? And maybe we don't. Maybe in 6 months we don't. Maybe the market tanks again. But that's why a market can go up in spite of bad things happening. It's the general consensus is it's going to be temporary.
So they're looking at, all right, well, look at all these new cases.
That's right.
Look at bars and restaurants, movie theaters, things
like
that.
They're being closed. But then on the other hand, there's some positive news and vaccines and treatments and
people aren't dying.
Yeah, not as much as they were, right? So maybe it'll get better.
Right.
And we got all these, it's impossible to predict. So we generally say stay invested and don't worry about market timing. And if you've got a lot of money to invest, if you're nervous about it, just invest a little bit each month, dollar cost average, if that makes you feel better.
Yeah. And it's hard. You're trying, Bruce, it's just being patient, but I just read another article of some guy lost, some 30-year-old lost another $1 million in Robinhood.
Oh boy. Yeah.
Trading options, doing that, right?
Yeah, sure.
Because we have almost like this gambling mentality.
Yeah.
And it's boring to see your accounts just, hey, I don't want to invest and wait 15 years to see, or 10 years to see my
because I can double my money in 10 days if I pick it right. I can also lose everything.
So investing should be boring. It should be boring. That's why this show is really boring.
It's the worst.
So, but yeah, did you miss the discount? I don't know. Well, think about it. What's the goal for the money?
Yeah,
do you need the money 10 years from now? Do you think the market's going to be higher 10 years today than it is now? Well, buy now. You got your discount.
Yeah, that's the only explanation, right? I mean, it's and the answer is you'll know in 10 years, right? But the thing is, if you look at almost any 10-year period, there are exceptions, but almost any 10-year period, the market's higher than it was 10 years earlier.
Right. Especially, I don't think it's ever been lower in a globally diversified portfolio.
I agree with that. Yeah,
I think the S&P during the last decade.
2000 to 2010 actually went down. That's really unusual. But a globally diversified portfolio in that same period went up.
Vanguard's VTSAX, that's the total stock market index fund, is pretty popular. So why not go all in on it? That question has been asked before on this podcast, and that episode happens to be the most popular one we've ever released. If you missed it or you want to relive it, you can find it in the podcast show notes at yourmoneyyourwealth.com. So what do you think? After hearing the fellas doing all of these retirement plan spitball analyses today, do you think maybe it's time for you to email them your situation and see what they spitball for you? Or for more than just spitballing, you can sign up for a free 2-meeting financial assessment with one of the certified financial planners on Joe and Big Al's team at Pure Financial Advisors. You can do that in the show notes too. Just click the link in the description of today's episode in your podcast app to get there.
Go to yourmoneyyourwealth.com if you got money questions. We will answer those questions right here on the show. We will try not to do so much chit chat now.
Yeah, we got a comment from long time in China.
Long time in China.
So when someone complains, they don't give you their name. They just make up a name.
Yeah. What do you say? Good topics, but too much chit chat.
Yeah.
It'd be great if the host can stick to the point. The banter is not funny.
Well, China, long time in China.
We never claim to be comedians. It's like we're just talking about certain topics. And if we get sidetracked, we get sidetracked.
Here's the thing. You can tune in or you don't have to.
You don't have to.
Yeah. So there you go. That's what we got. We still got 4 stars, though.
I know. He gave us 4 stars.
But not 5.
Not 5 because we're not always funny.
Not very funny.
So, yeah, decent topics if they just stay on topic.
If they would just get to the point.
Jesus.
I listened all this time to get the point.
Oh, these guys just drive me nuts. How you liking this segment, Long Time in China?
Pretty bad so far.
Hey, we got Massey. Is that right?
Sounds good to me.
Massey?
Yeah, I like it.
All right. Is it a good idea to have some individual stocks in a taxable account? I don't know. Someone just sends just random stuff.
Yeah, right.
All right.
It can be.
Sure.
If you pick the right one.
I guess so.
Well, let's go to the tax benefits first of all. There are tax benefits of doing it that way because with an individual stock, basically you have dividends on it potentially, but there's no capital gains until you sell it.
Yeah.
Right. So if you buy a mutual fund or even an index fund, there's going to be some gains and losses because there's some sales inside those funds which are taxable. So if you own an individual stock, it is more tax efficient.
It's one of the most tax efficient vehicle you can possibly own.
But I don't own any in my taxable portfolio account. And the reason being is I'm not willing to take that much risk on an individual company. So for me, I understand it's a better tax benefit to have those individual securities, but I don't want to, there's too much investment risk for my liking. So I would much rather have an index fund or a low-cost ETF or something like that.
Because you're still going to get pretty good tax treatment on it.
Yeah, that's right. Because, I mean, if I went with an active mutual fund, meaning one that the fund manager is trying to beat an index, and so they're buying and selling all the time, that's very tax inefficient. But if I buy an index fund, let's just say an S&P 500 index fund that's trying to mirror the S&P 500, they're not really buying and selling except when people are adding money and taking money out. So there's very little capital gains. Yeah. So I don't really have much taxation on it other than the dividends, which I would have anyway with stocks. So that's why I don't really like individual stocks. They're very tax efficient, but I'm concerned about the investment risk. Now, I will say, if you happen to pick the right stock.
How about you pick Tesla? What's Tesla up right now?
Yeah, I mean, I
think it was up 14%.
If you would have invested in Apple stock in 1980, you picked the right stock. But if you would have invested in the other 2000 that didn't do as well, you might have been sorry.
Yeah, there you go. That's 5 days, a couple percent.
Yeah. But anyway, that's always true of stocks. There's a lot more risk because it's a single company. You can do much better than the market. You can do much worse than the market. I'm not willing to have my investment be that big of a roller coaster. So that's why I go with index funds and ETFs.
Yeah, I'm with you, Al. I don't own an individual stock either. I was thinking about, maybe putting like a couple grand
in something just for fun.
Yeah.
What would you pick?
Huh?
Maybe I shouldn't have. Maybe that's like recommending something.
About one share of a stock a few years ago.
You did?
And it's done very well since.
You have one share of one stock?
I bought one share, and a couple of years later, the stock split. So now I actually own 7 shares.
Wow. You should be an analyst.
Yeah. Well, as they say, the range of returns is much greater with a single stock. You can do much better or much worse than the market as a whole.
Hey, did you see that email that Brian Perry sent in regards to the people that lost money owning individual stocks versus people that lost money owning ETFs over the last 5 years?
I missed it somehow.
Damn it, because I'm going to say something that's probably wrong. But the gist was this.
All right.
Is that if you owned like an ETF, index fund, mutual fund, any basket of stocks over the last 5 years, 7% of people lost money. Okay?
Okay.
If you owned individual stocks, around 50% of people lost money.
50. Okay.
So that's the difference, right?
Okay.
You could hit a home run, but you can also strike out significantly by owning individual stocks. With ETFs, index funds, you're kind of just hitting base hits.
Yeah, right? and I think, and I've heard that before too. And I think, Joe, that's because when you look at indexes, just a handful of stocks bring everything else up. It's just that you don't know which ones they're going to be.
Exactly. All right, folks, that's all we got for you today. Send in your questions. Thanks so much, and we'll see you next week.
Robots, beer, and stupid purchases in the derails today. Stick around to the end if that's your kind of thing and you aren't long time in China. Your Money, Your Wealth is presented by Pure Financial Advisors. Get that detailed, personalized financial analysis of your situation by clicking Get an Assessment at yourmoneyyourwealth.com or call 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Our website's all messed up. It's full of bugs. We're getting it fixed. But the Ask Joe and Big Al on the Air is temporarily getting destroyed by robots.
Yeah, that's the weirdest thing, right? What do the robots care about?
I don't know. They have a lot of
They really like our show, apparently.
Yes. So
in the meantime, if you go to the page, you can actually click the email address, info@purefinancial.com, and just send in your questions as an email instead.
I guess people like to do the other thing a little bit better. Maybe it's confusing. I don't know. Right there, that $50,000. I wonder if he's got that's part of the little beer budget.
Yeah, maybe so.
A little Busch Light. That's a favorite up in Minnesota.
It is. Yeah.
Oh, Busch Light. Yeah.
PBR.
No, PBR and Busch Light.
Coors Light, is that big up there or not so much?
I drink Coors Light.
I know you do.
So when I'm in Minnesota, I drink Coors Light. But if I'm at a relative's house, it's either PBR or Busch Light.
Got it. Those are your two choices.
Yes.
Got it.
Unless I bring my own.
Got it. Okay.
So, my mother drinks Bud Light.
Bud Light.
Which
okay.
she does drink. But everyone else, that's all I see. Busch Light.
Got it.
It's gross.
It's cheap, right?
It's very cheap. Well, maybe that's just the folks I hang out with.
Maybe.
No, you can't have another Star Wars mask.
You know what? The segments of stupid purchases could be coming up next.
Could be.
Could be.
I think you're entitled. It's been a long time since you got that Darth Vader mask.
I have not had a really stupid.
I'm still wanting to see you in a Chewbacca costume.
Chewbacca could be coming out.
That would be perfect because you're like 6-7 feet tall, whatever it is. So that would be perfect for Chewbacca.
What did you just say?
You're like
6 or 7 feet
I
tall.
thought she said I'd like sex and 7 feet tall. I'm like, what?
Wow.
What are you talking about?
No.
So I'm wearing these headphones that I can't hear Andy very well, but I can hear everything that Alan breathes.
Well, you don't need to wear the headphones.
I know.
But you like to hear me breathe.
Yes, I just feel
it makes you relax somehow.
I'm in the zone, Al.
Yeah, right.
You got to put these on. You got to act the part.
I suppose.
You got to be prepared. So when you're on the radio and if you don't wear headphones, it just doesn't feel right.
I know when we used to do it in the studio at the radio station, we always had headphones on. That's how you did it. And I remember sort of cranking it up. You know, my voice sounded okay when I cranked it. If it was low, it's like, what did you say?
So, yeah. Yep, I do have a lot of stupid purchases. Darth Vader mask is one. Stormtrooper masks are.
You got them too?
Oh yeah.
I'm saying if you had kids, you would have to. You'd have to then convince them not to get stupid things when you're just as bad at it. So it's a good thing that you only have yourself to manage.
True. Yeah. I bought a golf bag that is like larger than life.
Can you spend the night in it?
You could put a case of beer in there. It's like a staff bag. I don't even know. I'm not even that good at golf, and I have like this staff bag, like a pro bag.
Is it? Oh, really?
It's giant.
Giant.
It looks good though.
Do you have one of those bags that's like on a remote control that you can?
No,
didn't go that far.
Don't have one of those. I have seen some of those out on the, one of the carts.
Yeah, they kind of follow you along. Yeah, right.
No, I don't have that.
That's the next purchase.
No,
it's on Amazon coming a couple weeks.